Okay, I think we're going to get going here. Some people might be arriving a little bit late, but that's fine. We won't get to the good stuff for a few minutes anyway. So, good afternoon, everyone. Thanks for taking a few minutes today to listen about fraud prevention, and hopefully you'll find some good tips that you'll be able to use in your organizations. Just some housekeeping matters. If you have any questions about the materials, go ahead and use the chat feature within Teams and type in your question, and if we have time at the end, we'll try to take as many questions as we can. PDF of the slides will be sent to everyone who registered, and also this is being recorded, so you'll be able to get a copy of that as well. And we also, at the end, we're going to have a dozen ideas that we're going to talk about. Betsy's going to talk about. Well, we also have a PDF of that we'll also send to you. So anyway, so my name is Edward Schmitz. I'm a partner here at Hantzmon Wiebel, and in the business advisory area. And part of that is fraud prevention and sometimes investigation, which isn't nearly as much fun. Fraud prevention, that's where really I like to focus my time. Fraud investigation there's usually a lot of, let's say, emotions are running pretty high in a fraud investigation. Money's typically been stolen and people are upset about that. And, whoever had the money stolen is really upset. And then the person who stole it is looking at jail time and prison. And so they're upset, and there's a lot of emotions going around, so that's not nearly as fun as fraud prevention. But I'm also joined today by Betsy. Go ahead, Betsy, and you can introduce yourself.
On mute. Hello, everyone. I'm Betsy Rice. I'm a supervisor in the audit department at Hantzmon Wiebel, and I am also a certified fraud examiner. Ed and I have worked together on a few fraud cases through the years, a couple sizable ones. And as he says, we would much rather spend our time on helping our clients prevent fraud in the first place than investigating it in the aftermath. So with that, I will turn it over to Ed.
Okay, so here's our agenda today. So, we'll talk a little bit about some common fraud myths, and we'll actually talk about some frauds that we've seen. To give you some horror stories out there. We'll talk about some common frauds that employees commit. And we'll talk a little bit about the fraud triangle, the ideal climate for fraud opportunity, and the red flags of fraud. And then we'll actually get into the prevention and the detection part. And then we also have some resources for you. So hopefully you'll find those helpful. So just to start off, just some recent fraud headlines, just to let you know, fraud is happening out there. And actually the Association of Certified Fraud Examiners believes that with COVID, there's going to be even more fraud because organizations have changed how they do things. There's not as many people maybe in the office, so segregation of duties becomes more of an issue. So they're anticipating more fraud in the wake of COVID-19. But anyway, just some local stories here. $500,000 embezzled from a Charlottesville law firm. Augusta County woman facing 6 counts of embezzlement. That was she was working for a dentist office and stealing patient receipts. Virginia Power Company workers siphoned $1.6 million in customer checks. That was one where the person, longtime employee, good employee as far as everybody knew, but he found out that when companies would file for bankruptcy, they would typically owe the power company a lot of money, and it would take years to get through bankruptcy court, and before finally they would get some kind of a settlement. And he actually opened up a separate account that he controlled, but with the same name as the power company, and he would take those checks because that money had already been written off. Once the person declared bankruptcy, they wrote the account balances off and moved on. But when they actually got the money a couple years later from the trustee, no one was looking for it. So therefore, he was able to take that money and nobody really missed it. So I thought that was a little interesting one. We've also seen something similar to that we investigated. a few years ago. And then Lynchburg real estate owner pleads guilty to embezzling $550,000, and then 1 in 5 employees would sell their passwords. So anyway, it is out there, it is happening. So really, what we're going to talk about today is just to try to make it as difficult as possible for the employees to embezzle money or any other assets, I guess. And then also, if it does happen, to detect it quickly. So, and keep in mind, you can never totally eliminate the threat of fraud. Even if you segregate duties perfectly and on paper everything looks perfect, if you have employees who are colluding together, they can commit fraud. So it's something that there's always a threat out there, but you have to try to minimize it as much as possible and manage around it. So moving on here. So some common fraud myths. Some of you may have heard fraud only happens in big organizations. Well, that's not true. A lot of times smaller organizations don't have controls in place, so they're sometimes, oftentimes an easier target. And these people who commit fraud, they're looking for those easy targets. They're looking for organizations that don't have the controls in place, don't have the reviews in place, all those types of things. So that's definitely a myth. Our controller is a church elder, scout leader, devout family person, would never steal from the organization, or the bookkeeper's been with us 22 years, is like family, would never steal from us. And that's a myth. We've seen longtime employees. I just talked about it with that power company. And we've investigated some longtime employees that there was a lot of trust, and under the right circumstances, fraud can occur. So it is a myth. We don't handle cash. There's nothing to steal. I guess it's what you think about cash. I mean, if you're thinking just currency, if you don't have a cash register, that's one thing. But the cash that's sitting in the bank, that's cash. So your checking account or all those, those types of things, that's still considered cash. So and that's where they want to steal it from. Then the cash register only has a little bit of cash, but the cash, if they can get their hands on the cash account, there's usually a lot more money there. And our organization is audited every year, and if our employees were stealing, the auditors will detect it. Well, I am an auditor. We audit financial statements, and we're not engaged when we're doing a financial statement audit. We're not engaged to detect fraud. We do some limited fraud procedures, but that's not what we are engaged to do. So it's just a little bit different. If it's a fraud investigation or forensic investigation, that's a lot different. And that usually a lot more costly as well, because you're looking at a lot more detail and doing different types of procedures. So there's just because the financial statements are audited for organization every year, that doesn't mean that the auditors are going to detect fraud. So to scare you even more, I guess. So these are things that we've seen, unfortunately, and have investigated in some cases. So in one case, it was a retail operation. The person just wouldn't deposit any of the cash, took all the cash from the cash drawer and only deposited checks. So I guess most of the business was paid by credit card and I guess some checks, and nobody reviewed the fact that there was never any cash in the deposits. So that was one we had to look into a little bit. Another one, the person stole the incoming checks, only certain checks, kind of like if you think about the power company one where they only took the bankruptcy checks. Well, in this case, this person only took certain checks that came in. They were a little bit different, so therefore they were a little bit harder to control or to keep track of. And she basically opened an account in the same name as the organization or a very similar name, and just deposited the checks into there. So that does happen. Trusted employees shoot checks to self. This person had total access to the accounts payable modules so that he was able to add vendors. He actually wrote the checks, had access to the signature stamp, and also was in charge of the bank reconciliations. So we would call that a lack of segregation of duties. Actually, all 4 of those things should have been done by 4 different people. But in this case, just wrote checks to himself, and nobody was reviewing. And that's the part that, would have detected that a lot sooner had somebody been looking at the actual checks that cleared the bank's statement. So it's one thing to look at the bank statement, but to look at the actual copies of the checks and who's the payee on those checks. I think the person would have spotted it a lot earlier. Another quite large one that we investigated was this person was using QuickBooks and would print checks to themselves in QuickBooks, but then delete that check in QuickBooks. So they actually had already printed it, deleted it in QuickBooks, and then rewrote another check to a valid vendor, so to speak, with that same amount. So if you looked in QuickBooks, it would look like the check was to the vendor, but if you actually looked at the check that cleared, it was to that person's name. So that went on, and then sometimes that person didn't even bother to do that. They just wrote the check to themselves and cashed it. Paid personal bills, their credit card bills, things like that. And then also they used the a reprint feature in QuickBooks in the payroll section. So basically, like if you're running payroll and a check would get messed up in the printer, there's a way to reprint it so it doesn't add that money to the person's W-2 at the end of the year or whatever. It's just a reprint. Well, that person would reprint checks and cash both of them. And again, nobody was looking at that. No one was looking at the actual checks that cleared to see that's like, boy, there's a lot of checks with this person's name on the same date, dated the same amounts. So that is, that's what we've seen. There's another case at the bottom, payroll clerk, who, if anybody left, they would keep the person on just for one extra payroll, but change all the direct deposit banking information to their own bank account information. And of course, they would not have any taxes withheld or whatever because they wanted all the money. So at the end of the year, a person, gets their W-2. They don't recognize that there's a little extra payroll, more than they actually got. And nobody ever checks that. So, but the person was able to do that for quite a while. So, and going back to the previous one, one of these things, we talk about. We'll be talking a little bit later about, the reputation. Like a lot of people, when these people are caught, and it's actually happened to a couple of the people that we talked about here. The organization, in some cases they did, some cases they didn't. They didn't press charges, and therefore, it was there's no record of that ever happening. So they make a deal with I'll pay it back. Of course they get fired. Then they go to the next organization and they steal the money from there to pay back the first one. So just by doing background checks isn't a guarantee that the person hasn't committed fraud in the past. So just be aware of that. But at least in some of these cases, they were prosecuted. So and the people did jail time. So okay, so what we're going to talk a little bit about today is what they call occupational fraud, and that's really, the definition here is from the Association of Certified Fraud Examiners. The use of one's occupation for personal enrichment through the deliberate misuse or misapplication of the employee organization's resources or assets. So it's really the employees stealing. So, but there could be fraud from outside the organization. Vendors could commit fraud. Strangers could try to, steal money or, I guess hack your computer and ransom it, things like that. But in this case, typically those frauds are detected a lot quicker than an internal fraud. They can go on for, in some cases, what we've talked about in these cases were years and years and years, and it just adds up over time. And people say, well, how could an organization not miss that much money? As an example, there's another one that wasn't on the slide, but another one that I'm aware of. It was an automotive dealership where the controller just issued checks to herself and wired money. $4.1 million she took, and nobody reviewed her work. Nobody saw that she was doing it. And apparently they didn't miss the 4.1 million. And you think, well, how could an organization not miss 4.1 million? But, you know, over the course of 10, 20 years, I mean, you know, it can add up. So anyway, so here's the fraud categories that the Association of Certified Fraud Examiners talk about when they talk about occupational fraud. So misappropriation of assets, and that really there is that's the stealing of the stuff, a technical term that we use. So it's, you know, cash. They can be stealing. Could be, you know, inventory. Could be using their equipment that, you know, in an unauthorized way, you know, that they don't know about, you know, which is, you know, wearing it down faster than it should be. So that's the typical embezzling type things. So then another type is financial statement fraud. So that's, you know, think about like cooking the books, so to speak. So if an organization's trying to get a loan from a bank, or to keep a loan with a bank, or to get credit from a vendor, you know, they might try to overstate revenue, overstate net income, make things look better than it is, to get the loan or the credit issued. But, you know, could be the other way too. Financial statement fraud could be trying to reduce their tax amount, so they could be reducing those things to try to get away from paying taxes too. And then the corruption would be like bribery, extortion. Conflict of interest would be in there, and that's probably, you know, the one that for small organizations should be careful of, to have a really good conflict of interest policy in place and make sure that the employees know what that is. What you don't want is the employee to say, well, I didn't know I couldn't do this, so that I couldn't, you know, buy all the supplies from my, you know, brother's company or something, you know, or my own company. You know, I have a supply company on the side, and I bought all those supplies from my own company. Well, you know, you'd want to have a good conflict of interest policy in place to make sure everybody is aware of that. And just be aware, I mentioned it before, but, you know, there is external fraud. It does happen. I've seen it. Some of our clients have had it happen to them. You know, they've issued a check in a certain amount to a certain vendor, and all of a sudden the amount has changed. Somebody tried to alter the check, tried to change the payee. So it does happen. So just be aware of that. But really, the bigger dollar amounts happen internally. So common frauds: stealing cash. So skimming. So that's taking the money before it gets into the system. So some of the examples kind of showed that. So the checks were taken before they got into the system and were cashed, or just they took the cash out of the cash register. You know, that's another way to do it. So you always want to have good controls over that. Fraudulent disbursements. We've seen some of those in our examples where they just write checks to themselves. They could also alter checks. So if a AP person were to have the checks written out, they're signed, given back to the same person, those checks could then be altered, and then deposited that way. And so that's why typically one control is you wouldn't give the checks back to the person who prepared them. After they're signed, they would go to somebody outside of the accounts payable department to mail. Registered disbursement schemes. So if there's a cash register in place, you know, there's always the chance of somebody doing a false return or a false void to get the cash out of the drawer and make it look like it's valid. And then billing schemes. So that's where you're buying things, or, you know, that really aren't existent. So it makes it look like, you know, there's a vendor invoice. So as an example, if a fraudster wanted to set up a shell company to sell supplies, they could have an invoice, or let's say consulting services. They could provide an invoice, so it gets approved or whatever. Looks like it's all valid, but there's really nothing there. So they can get the money out of the company that way. In the frauds that we've investigated, they've not even gone to that extent. They've just written checks to themselves and didn't even try to hide it that way. Expense reimbursement schemes, that's pretty easy. You know, they overstate things. They try to put personal expenses through that are as business expenses, things like that. I've also seen examples where somebody will book 2 flights and put the higher expense flight and get reimbursed for that one, but they actually then get reimbursed and use a lower priced one to actually fly, things like that. That people get pretty crazy with some of these expense reimbursement schemes that I've seen. And payroll schemes, we kind of talked about that before too, where they can write checks to themselves either right away, or they might overstate their hours, things like that. And in inventory, in some cases, the inventory might be valuable. Like if you were at a jeweler, that inventory is very valuable and very small and is easily hidden. So that would certainly be a risk there. And how it affects your organization, the Association of Certified Fraud Examiners, they estimate that a typical organization loses about 5% of its gross revenues each year to occupational fraud and abuse. So if you do the numbers in your head right now, of 5% of your sales, or a not-for-profit organization could be contributions and total revenue in, it could be a big number. That doesn't mean it's going to be that number, but and hopefully you have controls in place to make sure it's not that number. But what it does is it's going to leave less money for the honest employees. So you can't give raises, maybe you have to cut benefits and not provide other benefits that you might be able to had the money not been stolen. And the organization's reputation, and especially not-for-profits, that their reputation is really important. And if a lot of times they don't want a big fraud at their organization being in the front page above the fold of the local paper, because it doesn't give the donors a lot of comfort that they're really managing the assets well and to get future contributions. So, but even for-profits don't want that type of negative publicity. So a lot of times that's why they will just try to work out a deal, with the person, get the money paid back, they get fired or whatever. But what it does, it just pushes that person on to the next group. And then typically they do it again, as it turns out. Once they do it once, it's they do it again. So let's I'm gonna turn it over to Betsy here for a little bit. Betsy, go ahead.
Okay, thanks, Ed. So why do employees commit fraud? The first thing we're going to take a look at is the fraud triangle. And really, for a fraud to successfully happen in an organization, you need to have all 3 legs of the fraud triangle in play simultaneously. So opportunity is the first one, and that arises due to either weak or non-existent internal controls. Improper segregation of duties creates opportunity, whether due to a small accounting department or changes to internal controls, for example, during COVID, where everybody was working remotely. Then the pressure leg, the second leg is pressure, that can be created by personal addictions or financial difficulties. An employee who feels overworked and underpaid may succumb to pressure. In the past year, an employee struggling with high medical bills in his family due to COVID may feel pressure to commit fraud. Rationalization is the final leg, and it is necessary for an employee to justify to himself his actions. I'm only borrowing the money, and I will pay it back as soon as my financial situation improves, which morphs into, wow, nobody noticed. I think I'll borrow a little more. So it starts out sort of innocuously enough, but it morphs into, over time, the realization that, boy, this can really go on. And so it goes on and it goes on. So unfortunately, small businesses often invite fraud to happen by having a poor tone at the top of the organization. And I'll talk about that a little more in a bit, but when you have a poor tone at the top, that very well can create a weak ethical culture throughout the organization. Secondly, if there are inadequate internal controls, if there are improper segregation of duties among the key accounting functions of custody, authorization, recording, and reconciliation, this presents a problem. It creates the opportunity. The next is failure to inform employees about company rules and the consequences of violating them. That's poor training. Again, it's an opportunity. Then we have poor supervision, low employee morale. This is one, as an auditor, I really pay attention to this when I go to see my clients. If I see low employee morale, that very easily could spawn into a fraudulent activity. And then blind trust in key employees. And Ed talked about this to begin with, but our recommendation is that certainly you trust people, but you want to verify. You don't want to have blind trust. It's really disheartening when you see a small family business, little mom and pop, and they go out of business after it turns out that their bookkeeper, who was like family, has been stealing from them all these years. And then finally, ineffective anti-fraud programs, policies, and procedures. These are key deterrents in preventing fraud. There are a number of behavioral red flags that a small business owner should watch for in his or her employees. Studies have shown consistently that these red flags, especially when they're in combination, might mean that the employee is more prone to steal from the organization. So some of the personal red flags would be financial difficulties, living beyond means, various addictions, a rule breaker mentality, somebody that always wants to take shortcuts, family problems. And then on the job, it might be unwillingness to share duties, refusal to take vacations. Those two go together really well. And if you see that, particularly somebody on your accounting staff, that should be a big red flag. Close personal relationship with vendors or customers, complaints about low pay, and excessive pressure within the company. So what can a small business owner do to prevent and detect fraud? Well, we have a dozen ideas for you. Now, keep in mind that there are several different types of organizations on the call today. So I'm going to speak of the owner of a small business, but think to yourself for your organization, if you're a larger organization with adequate segregation of duties, this could be the CFO that would be doing these review and approval sort of procedures. In a smaller organization, a smaller nonprofit, it might be the CEO, the president, or executive director who would be performing these. So think to yourself as I walk through, who's the right person to do these checks? Is the right person doing these checks right now, or should we evaluate, is there somebody else that should be doing them? So number one, review bank statements and cancel checks. The best practice is to have the bank send the statements directly to the owner's personal residence, or the owner can review the statements online with his own login. Either way, the owner needs to carefully review all copies of canceled checks every month, paying close attention to payee, amount, signature, and document review by initialing and dating the statement. Many fraud losses that Ed discussed earlier would have been avoided or at least discovered very quickly with this one simple step. Number two, the owner should approve all new vendors. Without this oversight, it's fairly simple for a bookkeeper to create a fictitious vendor, such as a shell company for a vague service such as IT or consulting services. Additionally, the owner should randomly review the vendor report printed in their presence. Number three, segregation of duties. And so we have three categories: cash receipts, cash disbursements, and then ACH wire transfers. And as Ed mentioned previously, when we say cash, we mean cash and check, not just cash. So ideally, wherever possible, 4 different employees should have responsibility for custody, authorization, recording, and reconciliation. An example would be for customer receipts, the person opening mail and handling funds to be deposited should be independent of the individual maintaining accounting records. For ACH and wire transfers, these are increasingly used. And yet, as we see our organizations using this form of payment more often, we don't see that the internal controls have kept up. It's essential to separate the duties for a wire transfer for authorization and initiation. Number 4. Ideally, the owner should hand sign all checks. No rubber stamps or electronic signatures. So in a couple of the frauds that Ed was mentioning earlier that we investigated, the bookkeeper had been granted signature authority or could use a stamp. Just by granting that, it made it so easy for that person to write checks to themselves. Number 5, the owner should review payroll to verify that he recognizes all employees and that the amounts paid are reasonable. So things to look for, Ed mentioned a couple earlier, but there could be a ghost employee, so a completely fictitious employee. There could be a terminated employee, which he gave an example of, that's still on the payroll. Or it could be that pay rates have changed. These are things to look out for. Number 6, ideally the owner should approve all write-offs. Left unchecked, an easy way for a bookkeeper to steal a customer receipt and then write it off through a journal entry. Number 7, if you use QuickBooks, learn how to use the audit trail function. So that function captures every transaction that's originally entered into QuickBooks, and then every subsequent change to that transaction, regardless of how small it is. So if the payee's name was changed and replaced to a vendor's name, or if the amount of the check changed, or if the check was actually deleted, this audit trail would pick up all of that activity. It's an important tool for uncovering fraud. Number 8, only approve payment after careful review of vendor invoices. So we feel like you all should talk to your banker about products that can reduce the risk of fraud. An example of this would be Positive Pay. Provide a list of check payees and amounts to the bank, and only those payees can cash them for the specific amounts listed. This is also available for ACH. And as Ed mentioned, we have had clients who had their vendor checks altered by fraudsters, and it was detected with Positive Pay and they were not paid. Number 9, prompt review of financial reports and reconciliations every month. The owner should compare the monthly financial statements with prior year, budget, and other expectations. Investigate any variance that differs from your expectations. For a bank reconciliation, don't accept the reconciliation at face value just because it appears to balance. Ask questions. For example, trace deposits in transit into the subsequent month's bank statement. Number 10, annual vacation requirement for accounting staff is a key control. Refusal to take that vacation may mean that you have a problem. Number 11, run background checks and call previous employers when interviewing accounting staff candidates. Prevention is the best medicine. And the final tip that we have is tone at the top, which I mentioned earlier. The owner should at all times set the highest example of integrity in their business dealings. So on the flip side, if an owner is commingling his personal and business activity on the books of his business, what kind of example does that set to the rest of the organization? If he's reaching into the cash register to grab $50 for lunch, you know, again, that sets a really poor example to everyone else in the organization, and that creates a very weak ethical culture, which can lead to fraud. An owner should set a very good example, practice what they preach, and others will follow. And Ed, I think I'm going to turn it back over to you.
Okay, so I have accumulated some resources here over the years. You know, I was in industry for 10 years, and you know, I wish I had these resources when I was in industry at the time, but we have them here. So some really good books that are out there. Preventing and Detecting Employee Theft and Embezzlement. So I don't know if you can see it, but that's this one. Excellent book, easy to read, but it's really laid out. It's really written to the owner, or probably an owner of a business, or the executive director of a nonprofit. You know, really what they should be doing, broken out by transaction class, you know, how to segregate duties, how to do it. I mean, it's really laid out very well. It's written, it's not a very technical book, you know, it's not a fraud examination type textbook or anything. It's really written right to an owner or executive director's level. So it's really, really well done. So another one that I stumbled across was this Accounting Control Best Practices by Stephen Bragg. And that one also breaks out transaction classes, and you know, what are the key controls in each of those transaction classes, and then how to segregate duties in each of those. So, you know, accounts payable, accounts receivable, how to, you know, billing your accounts receivable, or entering the payables. And so it really is well done. Lots of graphics, you know, flow charts with how things should be broken up and who should be doing what. So that's a really good organization. And for the not-for-profits out there, there's this book, Fraud and Abuse in Nonprofit Organizations. And this is also very well done. Breaks out by transaction class. You know, nonprofits are a little bit different. They've got what they call non-reciprocal transactions. So they're receiving donations, but the donor isn't getting anything back. So there's different risks associated with that. And the examples in here will completely scare you because he's got real life examples of various nonprofit frauds that have occurred. And it's just unbelievable, but what people would do to nonprofits. And again, in the nonprofit world too, there's a lot of times there's a feeling of trust. You know, it's like all these people are really working together. You know, it's, you know, working for a common cause to do good in the community. So there's a lot of times even more trust than in a for-profit organization. And so the fraudsters just gravitate to that, and they know they can take advantage of it. So, but that is an excellent book. And again, kind of scary to read, but real good examples, and it's broken out by transaction classes, and really it's geared exactly to nonprofits. So also on our website, we have an internal control diagnostic that you can complete. That's for free. Has a bunch of questions on there. You can, if you go to our website, and it's in the News and Resources tab, and you can fill that out, and it'll give you a little diagnostic at the end and say what you're strongest at, what you're weakest at, and we can help you strengthen those things. And then we also have what basically Betsy just went over, the dozen ideas for small business fraud prevention, and that is also on our website. It's a little bit trickier to find, but we'll send that to everybody here on the call, along with a PDF of the slides, so you'll have all that. So in summary, you know, hopefully by now you know that fraud's out there. It is happening. It's not just other people that it's happening to. It's out there. You can never eliminate it, totally eliminate it, but you just got to make it as difficult as possible. And if it does happen, to detect it as quickly as possible. That's the key. And really, you know, if you know where your weak spots are, you can manage, I think, better around it. And so that's where you want some kind of a diagnostic to understand, like, where are the weak spots? Where should we strengthen our controls, and how should we segregate duties more? Understand the red flags of fraud. So if you see somebody who's squealing into the parking lot with a new red Corvette that can't afford that, it might be a sign that something's run afoul. And implement fraud prevention detection recommendations that we have here in the dozen ideas as much as possible. And really, by doing those types of things, the fraudsters are going to leave. They're not going to. They want to find an easier target. So, and at that point, well, thanks for attending. Hopefully, you've gotten something out of it, and you're not too scared. You don't have nightmares tonight. Here's our contact information in case you want to call us, and we hope that you call us to talk about fraud prevention, not the fact that you think fraud has happened and you want us to perform a forensic examination. We can do it. We've done it in the past, but we'd much rather talk about fraud prevention.